Welcome to today's web lesson. We're going to be assessing price action and growth stocks. So we found a stock we like. It's formed a proper first or second stage base. We enter it at the proper buy point. We see that there's strong volume during the breakout and things are looking good. We've also placed our stops. Now we need to monitor the stock's price action to see how it's behaving. When you have a position, you want to look at its chart every day. Figure out what you see and if the price action and volume is positive or negative. We're going to focus on picking strong institutional quality candidates. Trend tools. We want to know, is the trend likely to continue or is it going to change? We're going to look at price to also determine, will the trend continue or is a change on the horizon? And we're going to use volume to help us do the same thing. When we use the word strong or strength, we mean accumulation or demand. When we use the word weak or weakness, it means distribution. Something important to remember is that sell signals pretty much trump everything else. So if you see a definitive sell signal or a combination of sell signals, you need to honor that, you need to be vigilant for it, and you need to exit the position accordingly. You want to pick stocks that institutions are interested in because they're the ones who move the stock up. Usually it's priced over $20 or $30. It'll have a high daily volume of 500,000 or more. Also, first and second stage bases usually are more successful than later stage bases. You want all the can slim qualities that we normally look for. EPS and sales up 25% or more and accelerating. You want the last 3 to 5 years to also be up. You want positive earnings estimates. You want a 17% or higher return on equity. You want to zero in on companies that have a strong service or product or something new and innovative that changes how we live and work. You want the breakouts to show significant increase in volume. That's the footprint that institutions are interested in the stock. You want to zero in on top rated stocks, which are often stocks that are in the top 40 industry groups. And you also want to focus in on the stocks that are leading the market, and they usually have a strong relative strength rating. We like to see 80 or better. Conversely, weak candidates are pretty much the opposite of everything we just said. They're low price stocks, less than $10, thinly traded, late stage bases, poor earnings and sales, or they're decelerating, negative sales and earnings estimates, horrible return on equity, perhaps high debt, diminishing margins, nothing creative or new, perhaps they're even losing market share to competitors, below average breakouts, and they're ranked in the lower 40 industry groups with a relative strength rating of less than 70. Late stage bases are more prone to failure. 80% of third stage bases will fail. 90% of fourth stage or higher bases will fail. That's something important to keep in mind when selecting your candidates. Now we're going to look at the trends and how we might be able to identify the probability of the trend continuing, weakening, or changing. The first thing we want to look at is the general market trend. We want a strong market. We want few or no distribution days. We want a large percent of stocks above their 200-day moving average. We want advancing stocks to beat declining issues. We want advancing volume to be stronger than declining volume. We like to see volatility decreasing. We don't want to fight the market. We want to buy when the market is in a confirmed uptrend because that increases the probability of success. 3 out of 4 stocks will follow the direction of the general market. When the market's weak, you're going to see lots of distribution days, lots of stocks below their 200-day moving average. You'll see that number increasing. You'll see declining stocks outpacing advancing stocks. You'll see declining volume larger than advancing volume. Volatility may be increasing. When the general market's in a downtrend, you want to sit on the sidelines and cash and keep your capital safe. Usually you focus in on the top 6 sectors and the top 40 to 50 industry groups, and you want to see an obvious uptrend in each group and in each sector. It'll be easy to spot weak sectors. You just look at a chart and you can see it's going down. And you can usually find good examples of that in the bottom 6 sectors and the bottom 40 to 50 industry groups. Then we're going to look at the leading stocks and how they're behaving. We want to see strong leadership. We want to see lots of first and second stage breakouts, or at least near the pivots. We want the leading stocks to be breaking out on high volume. We want to see new highs, indications that leading stocks are strong and advancing. A lot of times you'll see weakness in leaders as later stage bases start to develop. And when leading stocks break down, you want to pay attention. They can forewarn or foreshadow what's about to happen. You want to put this top-down analysis all together. You start with a strong market, an obvious uptrend, a strong industry group, obvious uptrend, and then zero in on that leading stock, which should also be in an uptrend. You combine these elements and you've greatly increased your probability of success. You want to focus in on leading stocks during a market uptrend from the strongest sectors and the strongest industry groups. How do we know if we're in a trend? Well, it should be obvious. And one way to do that is to draw an arrow. Here is a clear uptrend. It's nothing fancy. We're keeping it simple. In this example, price action is not really going up and not really going down, so it's sideways. You get a sideways arrow. Downtrend, clearly, sellers are in control here. The price is falling. You don't need to make things complex or use fancy indicators to identify the trend. Another way to measure the trend or figure out how persistent or strong the trend is with a line test. You simply draw a line or an arrow through as many consecutive days as possible. Here's another example. I was able to draw this line through all the price action. You look at all these, they're pretty steady. You have an advance, a small pullback, advance, small pullback, and so on. And then you get to here, and suddenly I can't draw the line through as many days or weeks of price action as I was able to before. And it's a little bit more choppy, lots of short lines. So there's a change of character. That tells me that perhaps the trend is changing. During a strong trend, price tends to follow through from one day to the next. If it's up sharply, then it tends to follow through to the upside the next few days. Whereas if it's weak, you won't have that follow through. Another simple tool to help identify the trend is drawing channel lines. To draw channel lines, you go to a weekly logarithmic chart. You want to connect at least 3 points of price over a long period of time. At least 18 weeks is best. And then as long as the price stays within this channel, you know that you've got a steady uptrend. If it should fall below or above, that tells you that the trend might be changing. So once you've drawn your channel trend lines, it's easy to identify weakness. Here we have the break of an upper channel line. You see the line? Price breaks above it, and then price begins to collapse. Often when price moves above a long-term channel trend line, it's an indication that exuberance or excitement about the stock or the rally is out of control and gone too far to an extreme. Here we have a broken uptrend line where the stock has been finding support along this line over a good period of time, and then it breaks it. That's a definitive sign of weakness. When you want a highly quantifiable way to identify the trend, there is the ADX indicator. A strong trend on the ADX is identified by an ADX reading of 30 or greater. That's true for both strong uptrends and strong downtrends. For an uptrend, the positive DMI must be greater than the negative DMI. For a strong downtrend, the negative DMI must be greater than the positive DMI. I'm not going to spend a lot of time on this. I just wanted to throw it out for those of you who like a hard right edge in identifying the trend. The ADX is the blue line, so whenever it's above 30, you've got a strong trend. When you've got a positive DMI, the green line, above a negative DMI, the red line, you've got an uptrend. When the reverse occurs, you've got a strong downtrend. There's another simple way to identify the strength of a trend, and that's by the percentage moves that it makes. For example, the NASDAQ and the S&P are up 7% in the last month, and the Russell 2000 gained 10%. That lets you know that small caps are outperforming the market. Most leaders have gained 15 to 25% in that month, but my stock has doubled. So yes, not only is my stock in an uptrend, but it is in a strong uptrend, and it's outperforming all other leaders, the Russell, and the major indices. You want to look at where the market, the leaders, and your stock were a week ago, a month ago. Here's how you would use percentage moves to determine weakness. The indices haven't made any forward progress in a month. For example, that happened back in August through September. The Russell 2000 lost ground. That tells you small caps are falling out of favor, risk is coming off the table, and that you should wait for things to unfold. And then most leaders were starting to break down. Now, if my stock has only gained 1% in the month, it's safe to say that is not an uptrend. But is it holding up better than the others? That could be some very useful information that could give me the confidence I need to hold onto my stock as the market starts to correct. As long as my stock doesn't flash any hard and fast sell signals. Another common tool that many traders use to measure the strength or the weakness of a trend is the support and resistance zones that you can find along moving average lines. You'd like to see price moving above a key moving average, but not to an extreme. You'd like to see a boss moving average that's containing the bulk of the move in place over a long period of time. If you see prices staying above a shorter term moving average, especially something like the 20-day moving average, that is a sign of strength. And if there is a pullback, you do like to see support at key longer term moving averages, especially the 50-day moving average. And the 200-day moving average is kind of like the last gas station for the next 1,000 miles. If you don't see support at the 200-day moving average, then it might be time to get out of that stock. Now, if you have price that's above the 200-day moving average at an extreme level, like 70 to 100%, that can be a sign that weakness is just around the corner, because you have this irrational exuberance, this extremely overbought condition, and it's just a matter of time before it corrects. Or if you see price crumbling below the boss moving average that's contained this bulk of the move for a long period of time, that can be a signal that things are changing. If you have failure at key shorter term moving averages like the 20, that can be your first flag, your first warning sign that the trend is about to change, and perhaps I better shift from an offensive stance to a defensive stance. And definitely, if you find that the price is living below or finding resistance along those longer term moving averages, especially the 50-day moving average or the 200-day moving average, you know that that's a negative sign and you need to be extremely cautious. Like I mentioned earlier, once price falls below that 200-day moving average, that's pretty much your last chance to preserve whatever profits you have. Here we have an example. We have a faltering 50-day. So price was above the 50-day, it fails, crashes through. That should raise a red flag. Here, the stock has already fallen through the 50-day moving average and is unable to get above it. Here, the price is run 70 to 100% above its 200-day moving average. You've got this extreme condition that will eventually correct, and often corrects extremely hard. Here you have price, kind of hugged the 50, eventually fell below it, then also crashed through the 200. Not a positive sign. It's a definitive sign of weakness. You need to be extremely cautious. Something new traders often overlook is checking to see if the order of the moving averages is sequential. In a strong uptrend, you're going to have the moving averages in proper order. You're going to have the 20-day moving average above the 50 and the 50 above the 200. Often when they cross over like this, the 20 crosses above the 50 and the 50 crosses above the 200. That's often a signal that the trend is changing, and changing in the direction of the crossover. Here's a sign of weakness. The moving averages are in inverse order, and the 50 is above the 20. And you notice the 20 crosses below the 50, and that begins the downtrend. And then both cross below the 200. It's pretty grim when you see that happen. And it's important to pay attention to the order of the moving averages, because that can give you an indication or an early warning or a hint as to what might be happening in the very near future. Another aspect of moving averages that new traders often overlook are the actual slopes of the moving average. When you have a moving average line that is sloping up or rising, that is a sign of strength, and especially when you have multiple moving averages like the 20 and the 50, both sloping up and continuing to rise up further. Conversely, when the moving averages are sloping down, that's a sign of weakness. And regardless which direction they're going, once they start to flatten out, whether they were moving down and now they're starting to flatten out, or they're moving up and starting to flatten out, that can be a sign that the trend is either about to change or perhaps pause and consolidate before continuation. Now let's look at price in relation to the moving averages from a different perspective. A sign of strength is when you have a negative space, or also sometimes known as daylight, between the low of the price bar and the moving average. This will often signify a really strong trend in place. So here you've got this moving average, it's sloping up, which we just went over and is a sign of strength. But then you've got the space between the moving average and between the price bar. Notice it's opening up and it's widening. That's a sign of strength. Now here on the chart, we've got a 9, 20, 50, and 200-day moving average. They're all in proper order. The 50's above the 200, the 20's above the 50, the 9's above the 20. And look, they're all sloping up. And not only that, we've got a significant amount of space between the 20-day moving average and price. We've got all this daylight or negative space. And if you look, we've even got some negative space between the 9-day moving average, which is incredible strength. Now we're going to look at pullbacks in context of the trend. When you have a pullback, you like to see a shallow pullback, an orderly pullback. So say the price ran up 20 points and it pulls back $2. You've had a 10% retracement. A pullback with an extremely volatile or deep pullback is a sign of weakness. So we like to see the shallower pullback, usually 15% or less. Once you get over a 15% pullback, a lot of times you'll see kind of a knee-jerk pullback, like a sharp pullback and a fast recovery, which just happens to be one of our sell signals. We like to see pullbacks hold above a shorter term moving average, especially the 20. A lot of professionals use the 20-day moving average, and so you should factor that into your trading at least a little bit. Be aware of it, just a bit. If you have a pullback that crashes through a moving average like the 50, that's a definite sign of weakness. How long does the stock pull back? Well, 3 to 7 days of lower highs after a stock hits new highs. That would be about the maximum I like to see on a pullback. Once it gets to 7 or 8 days, I'm going to start wondering if the trend is changing, or if perhaps the general market conditions have changed. And everything that we talk about in here, it's very, very important that you keep in mind it's within context of the general market. We're always using that top-down approach. What's the market doing? What are the sectors and industry groups doing? What are the leaders doing? What is my portfolio doing? On pullbacks, we like to see low volume. If we see big volume, that's a definite sign of weakness. And when they finally come out of the pullback, we like to see a big upward thrust and have it move into new highs or new high ground and have some follow through. If you're coming out of a pullback and it kind of wobbles or fails to go higher and just kind of meanders sideways and maybe crumbles back down a little bit, that is not a sign of strength. That's a sign that perhaps the trend for this particular stock is getting ready to make a serious downturn. So it's important to have follow through or carry over the next few days. If you don't see that, your stock could be getting ready to go sideways or come down. A lot of times when the trend is changing, we're not sure if it's pausing before a continuation or if it's going to break out or break down or what's it going to do. One tool we can use is the wide range bar. Now, a wide range price bar, you've got the low, the open, the close, and the high. And you've got a wide range between the high and the low. On a narrow range bar, the distance won't be as great. So perhaps this is $5. and this would be $1. Anytime you have a wide range bar that's greater than the prior 5 days, not only does the range exceed the prior 7 days, but it probably exceeds the last 5 days combined. So whenever you see that combined with a strong close, meaning it closes near the high of the day, that's something you want to pay attention to, especially on high volume. It lets you know that buyers are taking control. Here's another one. It's a sign of accumulation. Whenever you see a wide range bar to the downside, especially with accompanying large downside volume, that is definitely a warning. It's something you need to pay attention to. So you had this first warning here, then it meandered sideways for a while below the 50-day moving average, which is also a sign of weakness. Then it tries to come up and make a new high, but it fails to do so. Then it's down for 6 consecutive days, falls below the 50-day and the 200-day moving average. A tremendous sign of weakness. You want to get out. And then it's followed by several other wide range bars down. And the sellers definitely have control. Here's another example. Coming out of this flat base, you have this wide range bar down. That's a forewarning. Kind of goes sideways, struggling to get above the 50 and the 200-day moving average. Then you have another one. And even though you had these 3 weeks tight pattern, it still failed. I'm not going to go into a lot of detail here because Elliott wave theory is pretty complex and pretty dry and boring. But the gist of it is common to have 3 waves down or 3 waves up before you have a change in trend. So this example, this is the NASDAQ. It had 3 waves down during a market correction, then the trend reversed. Here you have the S&P, 3 waves up in this uptrend, then it reverses into a correction. I don't think it's any coincidence either that 80% of third stage bases fail, especially when you think about it in relation to the Elliott wave theory. I don't know definitively that there's any connection, but if I had to wager a guess, I'd say that there probably is. In this web lesson, we've tried to identify tools and techniques to help you determine whether the trend is strong or weak or possibly changing. If you'd like to learn more, continue on to part 2 and 3, where we assess volume and price action.